Good morning. It is Friday, July 18th, and the market is open. It's been open for about a half hour, and stocks are up in a on average. We've got some stocks moving up today. Looks like utilities are having a great day. Tesla's having a good day, and a couple of others. Looks like BlackRock's having a good day. The companies that are tied to crypto are having a really good day because there's some bills getting through Washington that are going to more legitimize stable coins, and that's going to create new types of businesses in that space. IBM's having a good day. Man, that might be good to take a look at. I've seen IBM do well over the last year, maybe two. So let's take a peek at that. It's been a while since I've looked at IBM. J&J had a terrific day yesterday. They had really good earnings, and they're doing well. So the market this week had days where it was really mixed. Only a few stocks would go up and a lot of stocks would come down. Healthcare had a horrible week. Healthcare stocks have just gotten shellacked. And it looks like it continues today, but yesterday was brutal. Elevance was down more than 10%. A couple other stocks were really hit hard. Looks like Blocks for Fun is on. Good to see you. Thanks for joining. Let me know if you want me to look at a particular stock ticker. Just put it in the chat and I'll take a look. And I appreciate your support of the channel. As we look at the stock market this week, earnings started. We had the big banks announce on Tuesday, and I thought that was going to be like the first day of earnings, and it was going to be met with either a rise in stocks or a fall in stocks, one direction or the other, and it really didn't move a whole lot. It was a little bit of a thud. Some of the stocks, some of the big banks announced, and their earnings were positive, but the stocks dropped a bit. The only stock that did rally was Citigroup, and they had really good earnings. I think that one because it's undervalued. It's been priced lower than the other banks, so it's trying to catch up to the valuations of like JP Morgan. So it's interesting to see that. And then we've had earnings from other companies, but most recently Netflix. And I created a video on Netflix on my channel, kind of expressing my view on Netflix. I think it's a terrific business. It's just an expensive company. And we'll take a look at Netflix a little closer today. It's down 5%, and that's after announcing really good earnings. Now that's a little bit of a sign of trouble. That means that investors saw the good news and said, the stock's too expensive, and they started selling it. That's the wrong thing to happen. I think it's only one day, but it could be the beginning of a pretty good correction, because on a day like that is when, again, it's good news. Why is the stock falling on good news? Well, because investors maybe looked at their valuations, looked at the priced earnings, looked at the fundamentals, and realized, enough's enough. The stock's done great. I'm going to cash in and get out of the stock. So maybe that's going on. It'd be interesting to take a look. So we'll take a peek at it. I've got a list of stocks that I want to look at. Some of them announced today, and I think all of them pretty much announced in the last couple of days. So I think it'll be interesting. So I invite you to come along. Just to kind of introduce, maybe there's a couple of new viewers out there. I'm a long-term investor. What am I looking to do? I'm looking to be a long-term successful investor of growing wealth, taking a stock and doubling the value of my investment over the next 5 years or shorter. So 3M's a stock we're going to cover today. Mission accomplished there. That stock's doubled in less than 2 years. That's what I'm trying to do. How do I find them? Well, I prefer to find really good, valuable, desirable companies that are priced at a discount. That's where I like to play. I like to play in small caps, especially small caps that are growing really fast, that are creating profit and cash. Those are real special, and those can really grow our wealth fast. So I'm a value investor that really likes growth, really likes technology, really likes communication services, and really like businesses that have a good future. They have a good handle on what's going to work going forward, not necessarily a good handle on everything that's worked in the past. So that's a little introduction to the channel and my point of view and how I go about things. So if that's interesting to you, that's what I'm going to do with it when I look at a company and a stock. I'm going to do valuations on some models that I created. I have a master's in business, I have an accounting degree, I have 30 years of professional experience. So modeling and understanding cash flows and financial statements is something that I've been doing for a long time. Looks like Dave 72 is on. Good morning. All right. A couple of names I haven't seen in a little while. Blocks for Fun and Dave 72. It's great to see you guys. So thanks for joining. All right, so let's start taking a peek at who announced and start looking at some companies. So today we had American Express announced, and I took a glance at these guys, and their stock was trading up higher. So we'll take a look at that. I want to look at Charles Schwab, and I'm going to look at Charles Schwab, Interactive Brokers, kind of combined, because both are in the same type of business. They're a little different, but Interactive Brokers has been a really good stock. We'll get into that. And since I'm in Interactive Brokers and Charles Schwab, I can touch on Robinhood and maybe even Futu and XP. So those are businesses that have been really doing well. I'll get into why. In addition to that, we've got 3M. We'll put that one up there. 3M announced. Their announcement was good, and I'll explain why it was good. If you look at a growth rate of 1.5%, it's like, well, how's that any good? Well, it's because they were in such a terrible position 2 years ago that if they could just stabilize their business and begin to grow, it's very good news because it's a really valuable business. So we'll get into that later. All right, so that is 3M, and I think those are the bigs for today. Yesterday we had, obviously, Netflix announced after the market closed. TSM announced before the market opened. They had good earnings. They grew quite fast because the semiconductor space is ordering a lot of semiconductors for TSM to manufacture. And, the stock traded up, and it helped other semiconductor stocks trade up. So maybe we'll take a peek at that guy because I think it'll be interesting. And we can look at Netflix. I released a video on Netflix. It really expresses my point of view. I released a video on 3M, by the way, as well, and it expresses my point of view there. And I released a video on Elevance. It looks like Amandio Marquez. You're asking about Elevance. After this stream, you can take a look at my channel. I released an Elevance video, and it really outlines how I feel about that. I think the Elevance stock, as well as healthcare stocks, are just getting beat up. And what's really interesting about the company, I'll make this point real quick, and then I'm going to save that point. I'm going to come back, and rather than jumping around, I'm going to make a point on Elevance and then move on later. So yesterday we had Netflix, General Electric. I'd be curious to see what General Electric is all about. My wife owns General Electric. She worked at General Electric. So we'll take a look at General Electric. And US Bank announced, Pepsi had a big announcement and their stock really rose. Now, I'm not a big, Staples kind of investor. I have one investment in Staples and that's about it. And I just don't get excited about Pepsi or Coke, by the way. Somebody else's investment, but their stock went up, like 10% yesterday, which was pretty amazing. All right, so let's get into it. We got plenty of stocks to cover, but if you're a member of the channel, a paid member, and you want me to look at a ticker, put it in the chat. I'll take a look. If you're not a member but want me to look at a stock, $5 super chat, and I'll take a look at that stock. So let's get going and dive into some stocks. Okay, so let's get into Charles Schwab and then Interactive Brokers. So Charles Schwab is a very well-known brokerage, and a lot of investors use Charles Schwab. They're up 50% in 1 year. Beautiful. Over 5 years, 187. This is the kind of investment I'm looking for. I mean, hey, who wouldn't, right? It's a really nice appreciation of one stock price. If you put 10,000 in 5 years ago, you'd have $30,000 today. That's what I'm talking about. That's what we want to do. Okay. And Charles Schwab is getting it done, has a PE of 25, forward PE of 20. And when we look at their growth, top line revenue growth looks really good. It's 16%. Now, does that make sense with today's market? Absolutely. We have a market that's been really energized in retail investing. You look at how this year we had a big sell-off due to that tariff scare in March and April, and then from April 9th to this point, geez, we've had a blistering rise in stock prices. It's been awesome, and it's been led by retail. So those are retail investors that are on Charles Schwab. They're on Interactive Brokers, and they are creating revenue for Charles Schwab because when they trade, Charles Schwab makes money. When they put more capital into Charles Schwab accounts, Charles Schwab is making money. So those things look really good. Also, the fees on like options, right? Options are really, I don't do a lot of options. I keep it as simple as possible. Investing super hard. I'm not talking you into or out of options. I'm just saying I don't do them. But companies like Charles Schwab, they love when you do options because that's where the fees are really, really good for them. Just saying, just saying. That's where there's some money made for Charles Schwab. All right, so cash flows look a little unpredictable. You got nice high cash flow at 8.6 billion, 6.2, 1.21. Now this I can understand because 2022 was a really bad year for stocks, and then they boomed back. So it's a little unpredictable. Now I'm not an investor at Charles Schwab. I haven't done deep dive analysis into them. And I'll tell you why. I'm a big Robinhood investor. Robinhood is my #1 percentage gainer, and it's going up again today. It's crushing it. I'm also an investor in Futu. Futu's having a glorious day, and I'll show that later. So to buy another stock of the same type, I'm careful not to do that too many times. So I picked Robinhood. I think I picked the right horse. It's almost like, hey, all the horses are fast, but which one's going to be fast and really rally for a long time? And that's been Robinhood for me. It was also smaller, lesser known, better story. But this one here, man, if you invested in Charles Schwab, I would say that the stock did its job. The cash flow is a little hard to predict. Margins are really good. Look at those profit margins, 31%. So these are brokerages, right? The type of business that we're dealing with is they create these platforms, and these platforms, people come in and trade on them, but they're not that expensive to run. Once you have the scale, you really start creating a lot of profit for Charles Schwab and so forth. So really good business. Growth looks great. To me, top line growth tells me Charles Schwab's getting more customers. Customers like the platform. They're doing more investing. All those things are positive. So good job, Charles Schwab. And the stock is up 3%. That growth is probably leading the way as to why, investors are liking the stock. 17 analysts cover the stock. They think the stock is fairly priced. It's only 2% overpriced, which is, in my book, fairly priced. They think it's worth $98. It's trading at 96. There is a bear analyst out there that says, it's priced too high, 61. And there's, the biggest bulls are not that bullish, right? $117 a share. It could rise some. So this one here, it makes me feel like, hey, you know what? How is Charles Schwab gonna create one more catalyst of growth? How can they create more growth? That would be a question I would have. And Charles Schwab is kind of an old school company and a good company. Now let's take a look at Interactive Brokers. Interactive Brokers is up 8.45%. And these guys are $107 billion market cap. Charles Schwab is 174. Interactive Brokers, these guys have been getting it done. 45.8%, 108%. So Charles Schwab actually has a better rate of return than Interactive Brokers over the 5-year. All right. These guys are having a good day. Both stocks would have been a good investment, but Charles Schwab would have won the challenge of providing a better rate of return. Charles Schwab has a better PE. This one's a little bit of a high PE, 33. Strong buy, but it's priced at a premium. Interactive Brokers is, I think, hardcore investors, traders, option traders, and so forth. It's a little bit more of their liking. Charles Schwab's a little more old school, kind of like traditional, formal kind of a brokerage. Interactive Brokers is probably made for more of the serious, high volume trader. They've been growing really well. Look at that revenue growth, just really solid. Revenue is telling me that Interactive Brokers is getting more customers. Customers like the platform. They're doing more trades on it. All those things are positive. This is excellent. Good job. And when we look at cash flow, they're generating cash flow. So very good job. Now, based on their growth rate, I could show you that this stock is discounted, because if I multiply 8.6 billion times 20, I get to about $172 billion of market cap, and these guys are trading at 109. So there's like maybe a 25% discount on the stock. If you measure the value of the business based on the free cash flows that they're producing and take the net present value of those cash flows, I'm doing that in my head because I've done this, 1,000 times. I have done it like 1,000 times across multiple companies. So this one here, if we did like a deep dive, there'd be a discount there. Now, why am I not interested is because I've already owned, 2-3 players in this space, and I can't own any more. I tried to pick the best ones and go with them, which is Robinhood and Futu, and those are doing great for me. But if you're in Interactive Brokers, I mean, you've done well over the 1 year. Who wouldn't be happy with 108%? And actually, Interactive Brokers, I looked at this wrong. These guys have outperformed Charles Schwab. They lapped them twice. 400% rate of return. Nicely done. Tip of the hat to Interactive Brokers. Man, it's such a beautiful chart. Nicely done. I don't know if anybody out there owns Interactive Brokers, but man, what a ride. And it's that growth. You see the difference? Why did these guys outperform Charles Schwab? It's this growth. This growth is really, really good. Now I'm going to compare them to a couple stocks that I own, and glad I owned them. Robinhood is up 6% today. Year to date, it's up 200%. 1 year, 363. Insane. And this thing was sold off, left for dead. I went through that trash pile and said, wait a second. This stock looks really good. And glad I bought it. So these guys, really high PE, really high forward PE. So what gives? What's going on, Robinhood? Why are you guys so darn valuable? Well, look at this growth rate. Just exciting. Now, this year, I give them a pass because this is the year that we had a really bad bear market. So it was ugly trading, man. A lot of people lost money. Some of these high-flying stocks lost so much value. Like Netflix lost 85% of its value. Meta, I can go down a long list of stocks that lost value, and trading was not that popular. But now, Robinhood's just killing it. And they have catalysts that are really going to build an exciting future. Not only do they trade stocks, right? Obviously, they do stock trading and options trading and all that good stuff, but they're deep into crypto. They're deep into stable coins. They're trying to use stable coins and the technology behind stable coins, the rails, as they would call them, to tokenize stocks and other types of assets and then be able to trade those on Robinhood. And Coinbase is trying to do the same thing. If they change that, they're going to compete with the New York Stock Exchange. They're going to compete with all these different exchanges and marketplaces that currently are valued quite expensively, but they've been around for like 100 years. They kind of been really nice and comfortable, feeling like their moat was impenetrable. Well, look out. Look out. They just fired a very powerful missile and it hit your moat and created a gaping hole, which is stablecoins. And Robinhood's trying to use that hole to get into that market and disrupt. I love that about Robinhood. Love them. I just love their whole story. I like them in part because I thought they were really intelligent, younger, entrepreneurs that wanted to rethink the way investments are all about. And I love that type of thinking. One of the reasons why I do so much individual investing and is because I did, use wealth advisors like 15 years ago, a mutual fund investor, mutual fund investor and so forth. And I could tell you firsthand that I was frustrated with the lack of performance, transparency. It seems like there's an old school mentality, there's a lot of people that are making a lot of money on Wall Street that don't do a whole lot, and their performance is mediocre in many cases. Some people on Wall Street are brilliant, okay, willing to acknowledge that. But I don't want to pay for mediocre results, or I don't want to pay for bureaucracies. I don't want to pay for just overhead. And Robinhood, to me, spoke to me that, hey, we're coming in and we're going to disrupt. We're not going to do it the way the old school did it. We're going to do it the way that it should be done based on the technology that's available today. Love that. So go disrupt, Robinhood. Keep doing your thing. So this growth is why Robinhood is just taking off like a rocket ship. But these investments, we're hitting pay dirt. We are hitting big time pay dirt with these investments here. This is what we're looking for as investors, man. These are just beautiful. Isn't that just awesome to see that consistently in this space, these stocks are doing great. We're in a bull market, so they're going to keep roaring. They're just going to keep roaring. Now, I used the logic of Robinhood and said, hey, well, over in China, they save their money like big time. People in China are working hard. The middle class keeps getting bigger and they keep saving their money. They're just big savers. And I thought they're probably going to be wanting to invest their money, and they invest with Futu. Futu's a lot like Robinhood. They're providing a new platform for investors, mainly in the Asia area. They're headquartered in Hong Kong, providing brokerage services to people in China, Japan, Korea, Vietnam, and places like that. And these guys are just killing it. And they're not that big of a market cap. So I started buying into Futu, as you guys that follow the channel and are members know. And this thing just keeps roaring. And it's one of my best performing Chinese stock right now. And the logic being is these guys are a lot like Robinhood and Interactive Brokers. And my logic kind of paid off. It's doing really well today, 10.8% rise. And it's not like a one-day rise, man. Year to date, 107%. Over the 1 year, 160%. Over the 5 year, look at this volatility. Holy smokes. But it's up almost 500%. So this guy here, I just like Futu a lot, and I love Robinhood. Keep going, guys. And if you're invested in Charles Schwab or Interactive Brokers, you are in the party. You are having a good time. All right, so we just kind of dug deep on Interactive Brokers and Charles Schwab. All really good investments. Let's take a look at chat here. Looks like Mike, the dividend investor guy, is on the scene. ADMA and XP. Let's take a look at XP first, because that relates to what we just covered with Robinhood, Interactive Brokers, and all the like. Blocks for fun. Take a look at LAD. Let's take a look at LAD. Happy to do so, guys. Nicolas. And did a video on Elevance yesterday after they announced. Take a look at that video at your leisure. It's got my comments in there. You'll be good to go. I'll comment on Elevance later, and I had some comments around it and around the healthcare space, but that'll be later. All right, let's keep moving. Jamie, how are you, sir? Comcast, they're crushing it this year. I owned Comcast for if it was a year or two, but we can take a look. Comcast is kind of an old school company. What I like about them is they're not staying old school. They're making the big changes that are necessary for them to be competitive. That's good. That's a real good sign because it's those old companies that stick to old models too long that really get into deep trouble. They got to be disciplined and move into new business lines and so forth to keep themselves relevant. And Comcast, I think, is a company that tries to do that. Just we'll take a look at that. It looks like that'll be the fourth stock on the list. Awesome, guys. Thanks so much for joining, everybody. We got a lot of people on the stream, got a lot of chat activity. Love it. Got some stocks to work on. I'd rather work on stocks that you guys are interested in. So I appreciate the interest and the attendance. Let's take a look at ADN. We're going to look at XP first to continue the conversation around companies that are in financial services. So XP provides financial products and services in Brazil. So these guys are doing what Robinhood, Futu, Charles Schwab, Interactive Brokers is doing. Now this is Brazil, so it's a kind of a different animal. So you would think that the logic is gonna play in Brazil. Brazil's a huge country. I think it's the most populated country in Latin America. I think it's the biggest economy in Latin America. So there's people that are probably making good money on that. So year to date, this is up 50%. It's had a pullback. Over the 1 year, it's down 4%. 5 years, down 58%. Now, Brazil is a country with its currency is not fully stable. I think that's part of it. I think there's a lack of confidence in the market as well and in the economy. So those things are things that ail XP. Now, I started buying into XP and I started to pump the brakes a little bit because I'm a dollar cost average investor. And these guys are discounted. I'll show you that in a second. And I still think, when are they going to announce? August 12th. So we're a little less than a month away from listening to what they have to say. And depending on, what they say at that time, I may invest more, but I think I have a small position, a tiny position in them. And I just want to wait and see till their earnings come out because it looked like, man, these guys are doing well. They're following kind of like the momentum that we're seeing in the other type of company, the same types of companies that operate in the United States, that operate in China. Just showed you examples. And I think Interactive Brokers operates in Europe really well. So I thought, okay, this stock got to do well. The fundamentals are there. And it's been declining while other stocks are advancing in the same space. So that's why I decided I'm going to pump the brakes on that stock. Doesn't mean I'm not going to sell it. Might mean that I put more money into it later on. But I'm like, wait a second. How come these guys are selling off when everything else is moving up in their space? They are highly discounted. These guys make money. They're profitable. They just create profit and cash flow in their business. They're growing. All those things look really good. But what is strange is that the stock's selling off. So what did I miss? Or maybe what's the surprise out there? Why is the market not buying into this stock? So I'm just slowing down my investment because so far it hasn't been a fun ride. I started buying into them, stock sells off, and I'm like, okay, let's hold off a little bit. Is there information that I'm not seeing, hearing? And this is one that I'm probably going to take to the member call. We have one member specifically that's located in Argentina. He has really good insight in Brazil. So I'd love to have him weigh in and see what he's thinking And it's not necessarily to put him on the spot. It's just more, he probably has a better sense of what's going on in Brazil than I do, because I'm way up here in the United States. So that's his stock. I don't, that's what I'm doing with it, Mike. And I did not dive into it head first. I don't do that. It's rare that I ever do that. I dollar cost average into positions. And this is one of the reasons why. It's like sometimes, you see a stock, the fundamentals look fabulous. The market starts doing something that surprises me. And I'm like, I don't get it. I don't understand it. And one of the things that I like to do as an investor is I like investing when I understand the business, I understand the economy, I understand the industry, I understand what's driving the success or failure of that business. And when something like this happens where, hey, this stock's moving down while their counterparts, even counterparts internationally, are just moving up, what gives? Why is Futu going up 10% at the same time XP going down? So I'm pumping the brakes. This still may be a fabulous investment. I hope it is. But let me slow down and kind of wait for this earnings, read the earnings thoroughly, and then proceed. So that's going to be my play on XP. So thanks for asking about XP, man. We dug deep into brokerages. We covered 5 of them. 4 superb winners, and one of them is questionable. XP is questionable at this time. Moving on to ADMA. ADMA Biologics is in the healthcare space, and man, healthcare has just gotten murdered this week. I shouldn't use that word because the CEO of United Healthcare did get murdered. So I apologize for that. The healthcare space has really seen a lot of capital leave that space. Jeez. It's seen so much capital leave. Now, Warren Buffett, who I've followed since I was, 20 years old. I'm 56. And he's just such a good North Star for me, such a good example. It's like, hey, not necessarily, I don't necessarily invest like him. I don't necessarily, do exactly what he does. But one of the things that he says is buy when everybody else is fearful. Buy when everybody hates a particular stock or space. And man, I'm beginning to really get really attracted to healthcare. I've been attracted to healthcare, but it's just a space that's just getting unassembled. It's just stocks are flying down. And meanwhile, you got stocks that are flying up. Now, those stocks that are flying up, there's a limit to it. Okay. At the end of the day, if you take away the labels of these companies, let's say you take away the label of ADMA, take away the label of Futu, you don't know what they are. You look at their financials, you could truly value the intrinsic value of those companies and say, based on their cash flows, this is what they're worth. So that's what I'm going to look at, is look at cash flows and understand that in healthcare right now, investors have to be patient and you have to be careful. Don't dive in head first and think next week this thing's going to rally. For all we know, it will, but we're going to need to see a really nice correction in technology and communication services stocks before healthcare starts getting that capital back. When everything's not working, healthcare stocks tend to really work well, and staples do as well. Having said that, let's take a look at ADMA. So these guys are a $4 billion market cap stock, and so they're nice and small. Revenue is $459 million. So you're buying the company for about 9 times, about 9 times revenue. Not too bad. PE is 20%. Really strong discount, strong buy. They've seen a really nice rise over the 5-year. Over the 1 year, it's still positive, but you can see that they've gone sideways for a while. They're still holding their stock price, but they're going sideways. They're going to announce on August 7th. So we're about 3 weeks away from that event. Growth is stupendous. Look at that growth, 62%. Quarterly, it's slowing down, but Q1 tends to be the slow quarter for them. So that seems to be a seasonal effect. That's just a slow quarter. In this growth rate, you cannot find this type of growth rate all that easy. It's hard to grow 62%. Now, ADMA Biologics probably has a treatment that is under patent that they sell to help patients with conditions that they're dealing with. And that's really attractive. The moat, the competitive advantage, the competitive barrier they have is very clear. They have these patents. This is a young business, and this growth is stupendous. Now we have 62% growth. That looks awesome. And we have free cash flow. They're generating free cash. So that looks good. We have margins are 52%. They are expanding. See how as this business gets bigger, their margins are getting bigger as well, because you only have to buy, infrastructure once, and then you can use it for a bigger company. So that looks good. Profit margins look great. Free cash flow margin looks good. If they can expand it, that'd be even better, and I think they will as they get larger. So what are analysts thinking about this stock here? Again, healthcare space is just, it's getting sold off. It's just like getting put on, it's almost like fashion, the item, the shirt is perfectly fine, but it's not in style anymore. So it just doesn't get used. And we have to wait for the technology stocks to maybe hit a wall and start selling off. And, those high flying stocks like Robinhood and Palantir and Nvidia and Broadcom, when those stocks hit a wall, and they will, it's certainty. Can't tell you if it's going to be tomorrow, next month, or next year, but it's going to happen. Then that capital is going to look for a home. And I think it's going to look at valuations like ADMA and say, yeah, this is a good stock. This is a really good stock, because analysts are saying, yeah, this thing's discounted by 60%. And you saw those growth rates. I mean, these growth rates are stupendous. As we look at the revenue growth, we're in 2025, and it's interesting that they're calling a growth number that's far lower than 65, which was 2024, because we looked at the quarterly, and the quarterly looked really good. 40% growth, and that's the quarter that tends to be slow for them. So I would actually expect that they're going to grow faster than this, but 6 investors are weighing in on this particular consensus forecast. And I would say that I'm more optimistic on the growth than that. And they're going to expand their profitability. That looks good. PE is going to drop. PE looks good on a growth stock like this. So this one here is, I'm going to show my valuation. This is a discounted stock. This is an absolutely discounted stock. I put a higher discount rate on small caps because they are higher risk, but it's discounted. Now, this one here, it's kind of an awkward time to buy into healthcare. I'm slowing down my investment in healthcare, but I'm very attracted to it. And I'm watching it and seeing if there's signals that, hey, are we going to move capital from the high growth sectors right now into healthcare? So I'm going to keep track of it. And I would do the same with ADMA, which is if we start seeing that, hey, the momentum in growth stocks is slowing down and we're going to see a pullback there, good time to start, hey, let's get refreshed on these healthcare stocks and start buying them again. But for now, it's a little bit of, hey, I'm holding off, I'm slowing down, don't need to jump in head first because I'm going to be waiting. I don't know if I'm going to be waiting a month, a year, 18 months. But I think once healthcare comes back, it's going to reward investors. It hasn't done well for the last 3 months or so. It's been pretty brutal. If you look at Elevance, we're going to talk about it. I can talk about it now. Elevance had very good earnings. The earnings were good. The expectation that the new bill, it does take away some benefits to lower income people that use the Affordable Care Act. It did take some benefits away from Medi-Cal recipients with respect to, again, the big bill. And those things will take away dollars from the space, but healthcare is 20% of GDP. It's huge. And companies that really know how to adjust best, and Elevance is one of them, they're going to do great, but it's going to take a while. It's not going to be overnight. Once the sentiment changes and healthcare starts making sense, okay, good. It looks like blocks for fun. Healthcare makes no sense. I think, I'd have to agree with you today. It's July 18th, 2025. It has no momentum, has downward momentum. But I would also say the stock market, geez, sometimes I think that anybody with a psychology degree has got a huge advantage, because how do you explain this psychology on Netflix? It's the same business, okay? And it's sold off by 74%. They were growing the business during this time. Just a lot of things were positive. How could anybody think, oh yeah, Netflix is no longer popular? Everybody watches Netflix, and it's sold off. Back to the point on healthcare. The psychology is super negative on healthcare, super negative. So it's doing this to just about every stock in healthcare. There's few examples where you could say, oh, that stock's doing great. But what happens is when things are so oversold and the market realizes, hey, it's actually a really good company, investors get rewarded. And that's long-term value investing. That's one of the plays, is finding companies that are good businesses, go into them at the right time, and then flourish. Healthcare is going to take a different path. I know Netflix is a very recognizable company. Every consumer knows what they do. Healthcare, we got to be smarter. We got to be smarter about it. But I agree with that comment. So that's ADMA. Now let's talk about LAD. And since I'm sorry, yeah, LAD. LAD is Lithia Motors. I've never seen this stock. So Lithia Motors is an American nationwide automotive dealership group headquartered in Medford, Oregon. It is the third largest new vehicle automotive dealership group in the United States, below AutoNation and Penske. Okay, so it's a retailer of cars. Okay, and P ratio is 9.6. So the stock 5 years done decent because it's had such a low point. And this graph I'm not liking, because this is taking a July 2020 starting point, and that the car business was terrible then because it was COVID. Nobody's driving. I'd probably say that I'd take a point like that, and then over that point in time, it hasn't really done a whole lot. Over the 1 year, it's up 16%. It's been kind of nosediving a little bit. Did they announce earnings? Let's take a closer look. So LAD. So they are going to announce on July 29th. Year to date, it's down 15%. 1 year, it's 12. 1 month, 7%. So it's an $7.9 billion market cap company. Revenues $36 billion. So you see that this is not a highly desirable business, right? When you have this type of revenue and you're paying, oh man, what is that? I don't even know what fraction to give you. You're paying a fraction of revenue for the company. You're also paying a PE of 9.5. Okay, so the market expects this is a retail business. It's automotive. Automotive is really going to see change and disruption, right? EVs. Tesla did something that is a threat to companies like Lithia Motors that do new car sales. Is they did not go with a dealer distribution model. They wanted to always distribute directly to the customer, and they stuck to their guns and did that. Will other companies do that? I don't know. I don't think so, but we'll see. So Lithia Motors, it's 9.5, strong buy, discounted by 28%. So they've been growing the revenue, and this growth is really good. Very good. Now, are they opening new stores? And I know dealerships are mostly parking lots, but they refer to them as stores, if I'm correct. Like, yeah, that's a store. Well, it's a dealership. It's a parking lot. Yeah, but they call it a store. Free cash flow, 114 million. Okay. Gross margins. This is why I'm not excited about these businesses. 15% total gross margin. That's before you have to pay for the accountants and the building and all that good stuff. And those stores are expensive to run. Profit margin is 2.31. So this one here, can you say that it's discounted? Maybe, because 114 times 10, you get to $1.1 billion. Let me check debt, because these guys have a lot of debt. They may be untouchable. $3.67 billion of net debt. So debt to EBITDA of 6. It's a lot of debt. Don't like that. So they have low margins, high debt. Cash flow is okay, but 1.1 billion, and they owe 18 billion. I think because they're financing their operation, and they also finance their inventory of cars, and they're holding the cars. Man, what am I bouncing around? Sorry about that, guys. So they're probably financing part of their inventory, and the cars on the lot are the asset, and the financing is on the balance sheet. So both on the balance sheet. The car inventory is on the balance sheet, and then the debt is there. This is not my type of business. I would not invest in this. And the reasons for it is margins are really small. Cash flow is limited. What's the best case scenario? They grow modestly. What's the worst case scenario? You have long-term headwinds, things that are taking drivers off the roads. You have robotaxi. Think about that concept is, this is probably about 15 years ago, maybe 10 years ago. I managed a team of sales reps, and some of the sales reps were fairly young. And one of the reps moved from, I think, Minnesota to California. And actually, two of the people that worked for me were in this boat. They came out, and just in conversation, they said they didn't buy cars, that they were just going to Uber, and they would rent a car when they needed it on the weekends, because it saved a lot of money on insurance. And where we worked was a very it was a high-rise building kind of area. And if you own a car, you have to pay for parking. And they go, you add that, you add the insurance, it's not worth it. I'd rather just walk, ride a bike, or Uber. And I thought, wow, well, it kind of makes sense. But then I kept hearing it from young people. And I heard it from a lot of young people that they're not driving anymore because Uber is so darn convenient. And now robotaxi is going to make it even more convenient. You're going to have robots drive us around. Incredible. And then people are door dashing like crazy. They use Uber Eats. You can have Instacart, deliver your groceries. Every business now, retailer, will deliver whatever you want. That's a force that is making the car less of a necessity and more of a luxury. I personally, 20 years ago, would drive 15,000 to 20,000 miles a year. Today, I force myself to drive 5,000 miles a year. And it's because for business, I do Zoom. I'm on a YouTube live stream right now. I don't need a car. So I think my personal lifestyle has changed, and I'm using the car far less. And some people are completely abandoning the ownership of a car. Back to Lithia Motors, you're trying to expand in a market that is changing lifestyle. And I don't think the robo-taxi thing is going to fade. I think it's going to get quite big. You think about the convenience. Geez, sometimes, especially when I, take my car into the service center, and they go, yeah, it'll be $1,200 for tires and $200 for an oil change and 300 or 400 for brakes. And geez, man, maybe that Uber, just taking Uber all the time might make a lot of sense. So I think people are really dealing with that. I think it could save them a lot of money. And I know in rural areas, you're still going to need a car. But again, there's some forces out there that are going to affect Lithia Motors. So I would not invest in Lithia Motors. And I don't know, blocks for fun. I don't know your, specific situation. I don't know if you love the car business, if you really understand it. And we should always use our personal kind of knowledge as one of the main tools as we look at companies. But for me, that's how I view it. And I'll share with you like my observation. There's a lot of businesses that I would prefer to invest in before I would invest in Lithia Motors. And I don't see any like excitement out there. Some exciting news that I saw, and there's one factor that's, and it's not going to affect Lithia Motors, but one big factor that's going to challenge the US automotive industry is China's putting out really good EVs. They're really doing that well. And they control the market of batteries for EVs. That's a huge advantage that they're going to have. So internationally, I think the US automaker is going to have a harder time selling. Domestically, I think they should be okay. And so we'll see how it goes. But I appreciate you asking. It's a car that I've never, it's a stock that I've never looked into. And feel free to ask questions about it. Be glad to answer them. But all right, so let's take a look at Comcast. So Comcast is a combination of really old businesses and some more newer businesses. They own a studio. They own networks like CNBC is owned by Comcast. And they also own technologies like they do a lot of broadband, and they do high-speed broadband. And they're trying to grow that part of the business. They own theme parks. What's the studio they own? Is it Warner Brothers? So they own one of the big studios. Now, these guys are, in a way, if you're an older investor and you're looking for a dividend stock that has like stability and you can kind of understand, Comcast is a pretty neat stock to look at. It pays a pretty decent dividend of 3.8. Year to date, it's down. Over the 1 year, it's down. 5 year, it's down 18%. Is this thing going to keep bouncing along the bottom? Let's take a look. PE ratio is super low. Man, look at that, 8.5. Now, these guys do have a streaming business, Peacock, that they are trying to compete against Netflix. But what oftentimes is the case is companies with legacy businesses struggle to compete with the pure plays because they're still kind of addicted to the old business. The old business kind of is what their talent, what their people are used to, operating, and they're more comfortable with, and they're not comfortable with the new business. Where Netflix is like, we only have one business. We're a streamer. YouTube, all we do is stream. And the guys at Amazon Prime, they just stream. They don't deal with linear TV, local TV stations, and so forth. So these guys are not doing terribly well, and their PE shows that the market is not all that interested in them. They have a discount, according to analysts, of 24.5%. Now, their revenue shows that, the market may not like them, but they just keep bumping, just chugging along, continuing to grow a little bit. Now, the business is trying to separate kind of like businesses that are made for the future, separate from the businesses that were created in the past. And I think that division in selling off assets or divesting a company or a part of the company might be a really good idea. That way, Comcast could receive the attention of Wall Street if they separate like the broadband connectivity business. They kind of separate those assets and create a new Comcast or a whole new different company. That might be a good idea. Now, the business that has the old assets probably wouldn't be worth much. So they're growing a little bit. Free cash flow is really high, $16.3 billion. So their cash flow margin's got to be really high. So the gross margins are 70%. Those are really good gross margins. Profit margins 12.7. Free cash flow margin 13. Very good. Okay. 21 analysts cover them. One analyst think that it's worth $60 a share. Worst case scenario, you'd only see a small decrement to your investment. Well, that's pretty good. Okay. And it's expected they're going to continue to grow slowly, and they're going to expand their profits. Okay. Let me look at their balance sheet. Make sure they don't have a ton of debt. And they do have a lot of debt. $99 billion of debt. Ooh, that's not good. Debt to EBITDA 2.5. Okay. So I forgot, see who asked about Comcast. I'm going to answer it two ways. And was it Jamie? Yeah, Jamie asked. Okay. So if you're a young investor, I would suggest don't look at Comcast. Go if you really do like media companies, if you really do like this space, there's other investments to consider. And investments, Netflix is uninvestable right now. If you watch my video, I'll conclude that it's really expensive. But YouTube is owned by Google. It's part of a conglomerate that has a lot of great businesses. You can dig and find businesses that have a really good place in the future. Comcast, unfortunately, a lot of their assets have a place in the past, and we're quickly forgetting about the past. And so that's for the young investor. For the older investor, I'd say you're 60 and you're like, I've made all the money that I need for me, my family, my spouse, and I'm looking to preserve really good income stock. This isn't a bad idea. Not a bad idea at all. I think some good things could happen if they divest certain assets and get some of that cash, make that balance sheet better, and start showing better growth. Because if they get rid of the stuff that doesn't have a place in the future, maybe their growth goes up. So it could be a nice long-term grower for an older investor. If you're in between, you're like, well, I'm not young or old, I'm in between. I would still say stay away. I think there's just better investments out there. Comcast doesn't have my capital, and I would not be putting any capital into it. It's just there's nothing there. Is this stock going to be worth more in the future? Maybe a little bit, but what I'm trying to do is I'm trying to go. I'll buy $10,000 of Comcast today, and I'll wake up 5 years from now, and that 10,000 is worth 20,000. That's the goal. If it goes above that, that's great. If it goes below that, especially if it's near $10,000 of value, it's a complete failure. It wasted my time, wasted my analysis, it wasted a lot of things. And I think that's why this thing isn't being touched by a lot of investors. Is this thing could be a giant waste of time. If you have that type of goal, is hey, I want to grow my wealth. I want to see a 15 to 25% rate of return every year. Man, there's a lot of investments you can look at that are far better. Let me show you an example. And I can't show you an example. Well, I could show you an example. So for a while, Comcast, I would say Comcast and Disney are similar, very similar. Theme parks, streaming services, linear TV, all kinds of same stuff. And Disney is doing okay. Year to date's doing good. 1 year. And this was a good investment like back here when they were kind of trying to figure out their business, right? They hired a CEO. It didn't work out. They brought back Bob Iger, who's a really good CEO, and things have really worked. Now, I don't invest in Disney. I don't think it's a good investment either, but it's a better investment than Comcast. So if you wanted kind of an old school business, there's businesses out there that you can look at. I'd rather look for something that has more new school in it, or has, what's going to be their catalyst to grow? How are they going to go from 94 billion to 150 billion over the next 5 years? How would they do that? And do they have the products, the ideas, the innovation? Apple is not growing. They are not growing, and they are a company you're supposed to grow. You're a technology company. You're supposed to grow, but you've gotten so darn big, and you're low on ideas. They don't have any new big ideas. So that's my comment on Comcast, and hopefully you found it interesting. Thanks for asking. All right, so Jamie, good to see you. Thanks again for tuning in and asking. Shadow Guy, I was actually talking with coworkers yesterday about the same issue. Tons of people don't own a car. Car sharing, very popular. You're in Switzerland, right? Yep. I'm hearing that more and more. And when I travel, 20 years ago when I traveled, I'd land, go to car rental, jump in my car, rent the car, go do business, go on a family trip, whatever I was doing. Today, exclusively on business, it would be very rare that I rent a car. Uber. It's just better. It's better by a bunch of different ways. And the car rental companies are just getting destroyed. Personal. 50% of the time, I would say 75% of the time, Uber. 25% of the time, I might rent a car. Sometimes I go to remote places, and you can't Uber. I mean, if you're going to go from airport to remote area that's 80 miles away, that Uber ride's going to be expensive. And then once you get there, you can't get around. So you got to get a car in that case. But yeah, my behavior's changed. So yeah. Okay. Mike, the dividend investor guy, asking about new. I did great with new and sold it yesterday. Excellent. Well, congratulations on new holdings. That's down in Brazil. Brazil is kind of some of these international plays like China, Brazil, and places like that, they have spurts of they go up really, really well, and then they kind of flatten out. And I think the market kind of gets a little concerned or gets distracted and not a lot of investment. Brazil's certainly taken that type of path, I've noticed. All right, so I think I've caught up. Yeah, I think I did. So thanks so much. I've got a lot of members on. So you use Turo, and see, that's my point there, Blocks for Fun. Turo is a disruptive company. They're coming in and they are going to go public, but Turo does like Airbnb, where you're renting, on Airbnb, you would rent a private residence, private condo, apartment, private area to stay in versus staying at a hotel. And Turo, you can private party rent your car. And I've looked into it. One of the showstoppers I had, believe it or not, for me, my insurance for some reason will not, like, I have an insurance policy on my automotive coverage that when I rent a car, I'm covered from liability perspective, and it'll cover the car as well with a deductible, of course, involved. But it specifically says I cannot use Turo. I cannot use private rental car. Like, it specifically says that, and therefore I can't use Turo because I try to use the service, and if I buy the insurance policy they sell, the insurance is so expensive, I might as well, rent from Avis or Hertz. So I've tried because I like new ideas, and I think these guys are going to be on it. They just got to fix that whole insurance thing, and then I'll be a steady customer. I mean, heck, I'll move away from Hertz and Avis in a second. But these guys, this is the future here. And of course, the future is all about like robotaxi. Uber announced just a couple of days ago that they made a big investment in, here it is, Lucid. And they made a $300 million investment in Lucid. And Lucid's going to be the producer of these robotaxis, with Neuro being the software that drives the car. And Neuro is a company that is in startup mode, and they got a lot of their startup money from Alphabet, Google. So Google Alphabet has a stake in Neuro. This is going to be a combo team that's going to go to market and try to put a lot of cars on the streets. They're going to be robo taxis. This thing looks pretty sharp looking car. I like Lucid cars, by the way. I see them on the streets and they look pretty darn cool. And this thing's going to be pretty cool going down the street. Currently, Waymo uses Jaguars, which are pretty cool looking cars. And I was in Austin, Texas last weekend, and I noticed a car that would look different, and it was Zoox from Amazon, and they used, I forgot the brand they used, but their whole equipment on top looked different. So that space is gonna be big, and it's gonna be, I think it's gonna be a positive because, when I visit cities, and call me crazy, I grew up in Orange County, California. Great place to live. Raised my family there. Love it. But it's kind of a suburb city or suburb area. We don't have high-rise buildings. So when I go to like San Francisco and you go with those high rises, it's so interesting to me. Or go to New York, Chicago. Like, I ride the subways in New York, and some people think I'm crazy because I think it's fun. It's like, wow, man, we don't have subways back home. This is neat. Half the time I get lost and I have to figure out how to get to the place I'm looking for because I'm not that good at it. But it's pretty neat. But I get out on the streets and there's like a billion cars, and there's people honking at each other, and road rage and all that stuff. Well, you get robo taxis out there, and you're gonna, I think, help with traffic because a lot of people are, in need of a ride, and I think it could be more efficient if you just had machines moving around, and there wouldn't be a bunch of honking. You wouldn't have road rage. In California, geez, I don't know what it is, but we have like so many high speed freeway chases where it's like every day on the news, oh, this car is getting chased by the police. Well, I don't think robo taxis are going to run from the police. So it'll solve that problem as well. No street racers, no none of that stuff. So we'll see. We'll see where the future takes us. It's going to be a while before they are a majority of the cars on the streets, but it's going to be an interesting space to watch for sure. All right. So we went over interactive brokers. We haven't touched on 3M yet, but let me take a peek at the market, see what's going on. What's going on stock market? We are selling off a little bit, just a tiny bit. Okay. And the market seemed a little lethargic earlier this week. That's how I would address it, is it just didn't want to go up as a whole. Just a few stocks were popping up, but a lot of stocks were selling off, especially healthcare. So let me take a look at the heat map. All right, so what is being bought at the stock market store today? People are buying Google, Lilly. J&J's having a good week. They're buying utility stocks. They're buying Tesla. Hey, give me some Tesla. They're buying some IBM. They're buying a little bit of Apple. They're selling Broadcom. They're selling AMD. Oh, my good friend Mike. They're selling your AMD stock. It looks like American Express is selling off. They announced today. Interesting. Berkshire's having a decent day. Some stock being bought. They're selling Meta. Netflix, selling it off. Selling it off like it's priced too high. So again, the news on Netflix, you announced that you're growing 16%. This is a $41 billion business. And in the quarter, you grew at 16%. You've been growing really well. And your stock sells off. For me, my interpretation is your stock price was way too high because you delivered what you said you were going to deliver. You're showing excellent business fundamentals, and the stock sells off. So not sure if it's the beginning, but I've been calling that Netflix is too expensive for a while. And, I'll keep myself honest, which is, it's one thing for me to think, hey, you know what? I did the right thing of selling. I made good money on it. That's fine. But the market had a different valuation of Netflix. They thought Netflix was far more valuable. So lesson to me is I should have kept Netflix. Should have kept it. Could have made more money. And that lesson I'll use for other stocks. I'm not going to sell some of these winners that are absolute winners. They're overpriced, but maybe I need to hang on to them because I can tell you it is not fun to watch Netflix continue to rise. It looked kind of like, oh, okay, I guess I was a little bit right here, but then it just roared back up after that pullback we had this year. So it's been interesting stock to watch, but it is priced a little high. I mean, 51 PE, 16% grower. You look at Google Alphabet, they're growing, think about the same rate, and they're gigantic. You get a PE of like 20, 18. You can get Meta that's growing better than 16. You get a PE of like 28, 30. So I can go on and say P of 51. I don't know. And then this is a one-trick pony. They do one thing. They stream. That's it. If streaming goes bad, not pretty, which is why when you see these pullbacks, I mean, people get freaked out fast over Netflix. So we'll see. We'll see if Netflix continues to sell off. It is an expensive stock. And, I'll always share my opinion. Sometimes, it'll be a stock that I own. Hey, it's overpriced. I'll put it out there. And there'll be some stocks oftentimes that have been discounted for a long time that never rise. That exists too. The market is, the term is the market efficient. Efficiency means is the market valuing stocks and truly addressing. If you remove the label of Netflix, just wipe this away, and we just look at the financials, what is this business worth, right? We would look at the profit. We would say, well, if I hold this thing for 5 years, how much profit and cash is it going to give me? That's how we would value it. And that's how I like to value companies, to at least have that sense of what's the value of this business. So when I do that for Netflix, I just find a very, very big premium. It's priced way too high versus the value that it has. So that is Netflix. If you're interested in Netflix, I created a video. I released it last night. And I created a video on 3M. And 3M seemed like it was going to trade up. And then the market decided, oh, see how I had refreshed this. But now it refreshed. It was going to trade up in the pre-market. And then the market decided, no, not so fast. And what's neat about it is, if you watch my video, my conclusion was, I'm not buying any more 3M. It's done well over the 1 year. It's not a very compelling discount, so I'm just going to hold my shares, and then the stock sold off. This is a good business. I think if they can start growing faster, it'll be worth more. But for now, mission accomplished. What I wanted to do with 3M was buy it when it was sold off. Nobody wanted it. It's a pile of rocks. It's worthless. And I was like, no, I know 3M. 3M's a great business, great brand. I'll buy it. Thank you. Thanks for the discount. And did really well with it. It's up more than 100% in the last 20 months. So that's what I'm looking for. I'm a value investor. I'm a long-term investor. I look for growth. But when you show me 3M and you show me a brand with a network that they have, can't resist. Got to invest, man. AMR. So let's talk about AMR. Man, if you're looking for excitement and you don't want to seek that excitement in tech, let me show you AMR. AMR is a materials company, and they mine the coal that goes into the steel supply chain. So when you manufacture, and I want it right, yeah, I guess produce would be a better word. When you produce steel, you take coal and you heat it up, you change the chemistry, and the output is steel. I'm sure there's some other additives in the process and so forth. But we've been doing this for a while. And these guys own mines in the West Virginia area. Now, these guys have been sold big time to the point where, man, if these guys could just come back to $200 a share, I'm going to double my money. So I took a position, a small position, 10 grand, and I dollar cost average into that 10 grand. Right now, I'm positive on my investment. And when we look at this historically, and you see that this is a cyclical business. You have periods when the commodity prices go up, this stock goes up, and then when commodity prices go down, they go down. Now, the behavior we've seen on government is tariffs, tariffs, tariffs. All right, cool. This is a domestic producer of coal. Domestic steel is probably going to be in higher demand. And there's the deal that happened I forgot the steel company. Is it US Steel? Got bought by a Japanese parent. And they're going to keep the steel production here in the States. So this stock is really sold off. And the revenues are down because of the commodity price. So if we could see commodities rise, which I have seen that commodities have been rising, this stock's going to do well. The annual, when you look at how they've done from a profit and cash flow, here's the cash flow. You see how they did well a couple years ago? And then their cash flow is still good, even when the commodities are down. But $1.3 billion of free cash flow in 1 year. And their market cap is 1.6. So it's 3 years ago, but the cash flow they produced in 1 year was almost 80% of the market cap of the company today. So that goes to show that if the commodity prices increase, this thing's just going to take off. And this is an investment where, can it go any lower? I don't think so. Only 3 analysts cover this stock, so it's not a big data set, but they agree that it can't go much lower, but it could go much higher. I'm thinking this thing can hit $200 a share, but we need commodities to improve. See here, if this happens next year and we have revenue increase like this with commodities rising, this thing's going to shoot up because their cash flow is going to go from 250 or so. And actually, their cash flow is probably around 300, and it's going to get up to 800 million, $1 billion. And this is going to be like Zim, the shipping company. That stock, when it takes off, it doubles, triples, quadruples in value very quickly. So I will be in. If it hits like an 80% gain, I'm out. These are not the stocks you stick around too long, because if you were here and you bought it and then it went up to 400 and then it came back down to 125. So you want to have an exit strategy defined when you buy this one. But this is an exciting stock when you look at the volatility of AMR. Jeez, man. I can't look at this every day because it's just wild. Like, it goes up. It might go up 10%, drop 6%, up 2%, drop, up, down. But over the last month, it's had a decent month. Over the last year, it's been brutal. Look at that. Whew. Tough. But it's not about, this is the rear view mirror. This is when you're driving your car and rear view mirror. But when you look through the windshield and you're like, well, can they have a reclaim to the business they had and just move the stock up to 200? Yeah, that's possible. It's going to happen in the next 6 months? Maybe. Over the next 2 years? Probably. I would say probably. Commodities are not going to sit idle. There's too much tariff talk. The economy's doing okay. You know, I kept thinking there was going to be a little bit of a recession, especially with all the tariff talk that we had early in 2025. But now all the economic indicators are saying, no, we're not going to be in a recession. We're going to be okay. So that's another reason why I'm like, this is worth the gamble. And I'm seeing, and it starts with value, right? I'm looking at value. I'm looking at this business saying, if I just looked at the fundamentals and I said, if we just take a very low free cash flow number, this thing's discounted, wildly discounted. It's wildly discounted. So what's the worst case scenario? It drops 20%, 40%. Best case scenario, it goes up 100, 200%. I'm not going to stick around for that type of rise. I'm out at 80%, but that was the rationale. It starts with fundamental analysis. What am I dealing with? Does this have value in it? In the case of AMR, it absolutely does. So thanks for asking about AMR. A wild stock. If you're looking for excitement, this is AMR. All right. Antone, if you'd like me to look at LNTH, $5 super chat. If you're a member, you get to request it for no additional fee because you paid a membership for the month. But $5 super chat and I can look at it. All right, so I'm going to do a last call. If you're a member and you want me to look at a stock, this is last call because I'm going to start shutting down the live stream. If you're not a member and would like to buy a $5 super chat, I would be happy to analyze the stock that you put out there. Taking a look at the market one last time. So it looks like we are ending Friday a little bit red. Now, my spidey senses are tingling. My spidey senses are like, well, if we're in the red and it is, looks like 2 hours into trading, we may end up far. It's going to be a down day and it's going to sell off more. So I wouldn't be surprised if the S&P is minus 5.5%. So I wouldn't be surprised if we sell off. Because if the market has an attitude to sell off, like we've seen our friends at Netflix who had 16% growth, and Netflix is selling off like this, I think it's going to create pessimism. And maybe people are like, hey, you know what? I don't want to sit on this stock over the weekend. I'm going to sell it. I'm going to sell this other stock. And maybe that happens today. Those are my spidey senses. And I don't know how accurate they are, but I'll just call it out. All right, guys. So looks like I didn't see any new stocks. So it was a really good stream. It's good to be streaming again. I was dealing with a cold this week, and I'm feeling a little better. So I'm glad to report that. And hopefully my voice was clear on this live stream. And I appreciate you guys attending. Looks like the market is thinking about what the market's going to buy, what it's going to sell, and we're going along for the ride. Next week we have more earnings. Qualcomm is up today. Mike, the dividend investor guy, keeping the stream alive. What's going on, Qualcomm? Qualcomm's a little bit of a contrarian stock within semiconductor. You go semiconductor stocks. If I said I'm going to give you a semiconductor stock that's growing, really profitable, has lots of cash flow, you'd be like, well, that thing must be up like 100%. And it's like, no, it's actually down 19%. It's like, what? So over the one day, it's up 1.68, which is, and the reason for it is the story, right? Qualcomm is not big in data center. Data center semiconductors are kings of Wall Street nowadays. They are the ones that are just absorbing so much capital. Qualcomm, Nvidia, Broadcom, and others. And this one is quietly just a really good company, 2.3% dividend, $168 billion market cap, $42 billion of revenue. So you're paying what, about 4 or 5 times revenue? And look at this growth. Nice growth. So, okay, it's growing. Well, do they make money? Absolutely. You want to make money? Well, let's make it, $11.7 billion of free cash flow. Their margins are 55.68. They have really nice profit of 26%, free cash flow margin 27. So it's like interesting. Now, Qualcomm, their primary business is, handsets like mobile phones. So they're in the iPhone, they're in the Samsung. Their Snapdragon chip is in my new Samsung. It was new a month or two ago, and it's been a high performing phone. And that Snapdragon chip is making its way into computers. And Qualcomm also has a really good defense business because they do a lot of communication semiconductors that are made exclusively for the military. This is a San Diego based company. So San Diego is a big military town and they have a lot of connections with the military. So this is a stock that is a value investor's stock in semiconductor. I've got a good position in them and I'm glad I own them. It's up 1.6%. Very good to see. And they're going to reward investors because eventually we're going to see that, value is value. You can't hold back value. Once you see that balance sheet swell with cash and you keep buying back shares and that profit keeps, ringing the bell, they keep growing, can't hold it back. Just not possible. And it'll come back, especially in semiconductor. Semiconductor, it's one of my favorite sectors because it's really interesting. It is cyclical. So you got to know when to buy, when to sell. And I've made a couple really good investments. And I've missed a couple good investments, frankly. I missed NVIDIA. And I will acknowledge that. I did not miss on Broadcom. I made some money on Broadcom. And the selfish side of me thinks I didn't make enough money on Broadcom, but I made some money on it. And I've made money on others. Like TSM, I owned for years. And I tripled my money on TSM. Thank you very much, TSM. Appreciate it. And moved on. So Qualcomm's having a good day. I think it's a solid stock. It's good to see it rise on a day when other stocks are selling off. So thanks for asking about that, Mike. All right, guys. So I think with that, I think I'm going to end the stream and just remind you, if it'd be great to. We've had several new members of the channel, and just to go over how you become a member. It's really easy. You go to the home screen of the channel, you click this join button that's kind of in the center to the right. You can see the different levels that you can consider being a member on. You can be invited to member calls, have access to my research, get to the Discord that we have. I think it's a really good program. And if you're a long-term investor looking to build your knowledge, build your skills, grow your wealth, I think it's a good place to learn, collaborate, learn from others, and contribute. In a lot of ways, when we talk about the investments we make, we're helping others by at least having one more point of view, one more opinion on a stock as we make our decisions investing our hard-earned money. So consider it. If it's something that is interesting to you, it'd be great to have you. All right, guys. Well, you guys have a terrific weekend, and I really appreciate you stopping by, spending some time with me on my live stream. And good luck with your investments. Take care.